midpoint of that wick right here, consequent encroachment, it could drop down there, not take out that low. So in your notes, anytime there is a short, stubby little wick, okay, and what do I mean by that? It would look like, look how big the candle is here. Let me zoom in a little bit. Okay, see how long this candle is, and then how little the tail is, the little wick. That to me is a very short, stubby little wick. In relationship, how am I basing whether a wick above a candle or below a candle is stubby and short? It's relative to its candle size from high to low. So that way there's your reference point. Versus something like this. So you have a long wick, and it's the majority of the entirety of the candle. See that? So in relationship, this tail or wick on the low of the candle is short and stubby. And many times you're going to find, this is what you want to have in your journal and in your study notes. Many times that type of low will get probed without going through it. And it'll stop at consequent encroachment for it right there. So in other words, give me a visual of what I'm referring to. It could drop down, come right to it, or just below it a little bit, and then retrace, and then at a later time come back down through it. Whereas a long-wicked candle, generally, if you're on the right direction, in other words, if you're looking at a wick like this and you're bearish, many times it'll go right to consequent encroachment and stop dead in its tracks and go the other way. Or if it's really weak, it'll only go up like 1/4 of the wick, stop right there, not even go to consequent encroachment, and then drop. The instances that it does that very thing, that is a real hardline indicator that you are in a very bearish market. Because generally you want to see the algorithm reprice back to consequent encroachment of a wick. If you're bearish, if it's a very, very long wick like that, consequent encroachment, which is the midpoint of the long wicked gaps, they're barriers. But if it can't even reach that while you're bearish, and it goes to the quarter range of the entirety of that wick, not the full body high and low, where the wick is generated from the high down to, in this case, because it's a higher closing candle, you'd be using that closing price to high. And those relationships will serve you well if you go forward. The other thing I want to teach about this morning for wicks is when you have a area where the candles create a wick, like for instance, like right here. See that? The body comes down essentially to the old fair value gap high there. And then the next candle we open here, we trade back down to the body of the candle. I'm sorry, the opening, or the high end rather, of the fair value gap on this candle right here. But we have this wick on this small little down closed candle right here. The next candle, when it opens and trades up and comes back down, if we have this candle here go up to what would be almost essentially the midpoint or consequent encroachment of the next candle, we don't even know that it's going to create this pattern, but we don't know it. But should it form that, generally you will see the consequent encroachment of that wick. If it's bearish, it won't reach it, and you can see that happening right here. I'm not cherry picking that. I'm showing you to go into your charts, and you'll see that is the case. Because this candle here is a precursor, then you get the actual wick here that's on the high. And when you see me sometimes taking live executions and I'm entering trades, I'm sometimes using that very criteria right there. And trusting that as I'm seeing the candle open and it trades right up to that point here, I'm trusting that it won't even go through consequent encroachment. I'm not fearful of it because it's that type of signature I'm looking for. It's kind of like justify the confidence behind the idea. We have this imbalance here that we didn't come all the way up into. I like that. I like the fact that we couldn't even come back to this old low. Remember what I was saying earlier about the relationships of the wicks in the candles. When they fail to reach the midpoint of the wick, and they're like it's a high, for instance, something like this. Okay, you're looking at that type of candle. And if you're bearish and the next candle tries to get up there but fails to get to even the midpoint of it, which is consequent encroachment, that indicates that you're really bearish. And the same when I look at a gap, like this sell side imbalance, buy side inefficiency, which is a fair value gap. By classification, the PD array is fair value gap. What kind of fair value gap? A sell side imbalance, buy side inefficiency. SIBI is what I usually abbreviate it in my charts. It's sell side imbalance. That means it's all one-sided, one big candle going down. It's lacking efficiency on the buy side. In other words, it needs to be offered at a later time with movement higher by price. The difference between this candle's low and this candle's high frames that SIBI, the sell side imbalance, buy side inefficiency. The market tends to want to reprice back up into the range and as far as the previous candle's low. If we see something like this, I like that. I like to see it in my intraday charts, in my intraday charts for my intraday trades, and it's just what I'm expecting to see price do. Even though it was a down closed candle, what it is it's a sell side imbalance, which means it was primarily too much of one-sidedness going lower. So the algorithm will want to reprice to offer fair value by going back up like it does here. The fact that we didn't come all the way back up to that area here and close into this candle's low, to me, indicates that that is weak, decisively weak, because of the same characteristic that I taught you with the wicks. If we can't climb up to the midpoint of a wick above a candle and we're bearish, that is extremely indicative of a lower moving market. So it's those types of things that I'm weighing as each candle's forming, and you'll hear me talk about it when we're doing live streams. I'll say, this is interesting to me. This is what I'm wanting to see. I don't want to see these types of things. If I say something like, okay, I don't want to see that right there, that's not surprise. That's not me afraid that the market makers are going to move on me. That's not me thinking, oh, they just changed the algorithm. It's just something I don't want to see this right now in the context of what I'm looking for, and I have to see it have a resolution to that immediately. And it'll make more sense as you watch me do more of it. But I'm not ever looking at price saying, oh my goodness, where did that come from? That's always a possibility when you're reading price. I'm never going to be surprised or shocked. Now, I would be, if we were in a market and I'm expecting price to deliver like it normally would, and for a non-CPI day, and it creates a CPI run out of nowhere, boom, that's a black swan. Then you will hear me say, what the, I'll go off the rails.